All right, good morning. This is the Milwaukee Enrollment Network first presentation of the 2019 year, the tax season and the marketplace overview. And this session really is that. It's an overview because we've been functioning with the health insurance marketplace, healthcare.gov, the Affordable Care Act, and as it ties to the tax season, because in a lot of ways, the Affordable Care Act ties in with how people do their taxes and how it associates with them having health insurance. And so this is really an opportunity to refresh yourselves on kind of these basic concepts around the tax season, get ready for people that might be asking questions for various reasons, and making sure that you feel comfortable at least knowing where to go to answer some of these questions for the consumers that you serve. It may mean that you have to do some digging, but I'm here to give you some of those resources that will help you find the information you need. So like I said, I'm Carolyn Gomez-Tom, Program Manager of the Milwaukee Enrollment Network and covering Wisconsin's Navigator program. I've been doing this role to some varying extent for the last 5 years, and I am happy to be your go-to for a lot of these questions as they come up. So anytime there's any issue or troubleshooting or something that you feel you don't know exactly where to find, please feel free to email me and I'm happy to help you figure it out. I do want to emphasize for this presentation and for any tax-related information that I ever provide you, I am not a tax expert. Navigators and enrollment assisters do not provide tax, legal, or accounting advice. Any of the information that's provided here is for informational purposes only, and it's not meant to provide or be relied on for tax, legal, or accounting advice. This is really crucial because there are professionals out there that can help people understand the specifics of their personal situation and their tax situation. And so for no reason should we be giving that information. What we can do is we can help them get the information from the marketplace. We'll talk about the 1095A forms. We'll help them understand what forms they should be looking for to fill out, for example, the 8962. But when it comes to, what should they do? How will this affect my return? Anything like that, that is something that we can at least direct them to their tax professional. And what we'll be covering today are really what I consider kind of the highlights of how the marketplace and the Affordable Care Act tie into taxes. So what do taxes in the marketplace have to do with one another? Why are we even talking about this topic? What's the shared responsibility, or also known as the tax penalty, for having no insurance? Who qualifies for an exemption from that tax penalty? And how can someone claim an exemption? And then tax credit reconciliation. So for someone who has marketplace coverage, has financial assistance in the form of a premium tax credit, and how are they able to reconcile that at tax time? So first I'll go through the overview of the Patient Protection and Affordable Care Act. This is probably a lot of what you've already heard and seen of, but the Patient Protection and the Affordable Care Act, also known as the ACA, or some people do still call it Obamacare, was passed in 2010. In 2014, though, was when the pieces of the law that impacted income taxes were truly implemented. And so the parts that we'll really get into are the following three: the requirement to have health insurance or pay the shared responsibility, having to qualify for an exemption if you weren't going to pay the tax penalty, if you were going to get out of having to pay that fee, and then the advanced premium tax credit reconciliation. There are other concepts that were included and impacted the tax to health insurance parts of the law. For example, families having to count their household as a tax household in order to determine what they'll qualify for in the marketplace. Modified adjusted gross income, if you guys remember the first webinar that I did, in this enrollment year around modified adjusted gross income. That is all about taxes if you look at it the right way, as that is that form of counting income is really all through how it's determined through your gross income and deductions and what that total ends up costing or ends up grossing for the family. But really, we're going to focus on these three particular issues. So first, I keep saying shared responsibility because this was the term that they came out with for the essentially financial incentive to make sure that folks had health insurance. And this was the name that they stuck by. So I put it in there, but we all kind of know it as the tax penalty. So the tax penalty or fee that people have to pay if they did not have health insurance. So it was made that under the Affordable Care Act, almost everyone was required to have some type of qualifying health care coverage. Or we also consider that minimum essential coverage or some type of insurance that was either grandfathered in from the law that allowed them to not have to pay this tax penalty. And I set up a link so that you can see all the various types of insurance that are still considered qualifying health coverage through the health insurance marketplace. But really the ones that we know very well are Medicare, BadgerCare or Medicaid, employer-sponsored coverage, marketplace coverage, veteran benefits, and then anything that's considered minimum essential coverage are for sure applicable coverage. And then what people have to do is on their tax form, they have to claim that they have had coverage for the full year or for the months that they did have coverage. And in a lot of cases, it wasn't a requirement to show proof unless you had marketplace coverage. For the longest time, someone who had marketplace coverage, they received a 1095A form, and that shows proof of what months they had marketplace coverage. But you should have also seen that people with Medicaid coverage would have received a 1095B form, or honestly, even employed folks would get a 1095B form from their health insurance company, showing proof that they were also insured for the full year. And then the 1095C form are directly from employers, showing that the employee was insured through the entire year. And so this verification helped make it easy for people to show that verification at tax time so that whoever was preparing their taxes could easily check the full coverage box. But then as we know, if you don't have health insurance, you are required to pay a penalty. And so each year, from the first year that the tax implications were put into effect, the tax penalty went up. So the first year, it was $95 for adults, $47.50 for children, and then there are caps for the whole family. So $285 for that 2014 year, which was the maximum was 1% of the household income, whichever was more, but they still capped it at that $285 amount. And then each year it incrementally went up until it kind of stuck around the $695 amount for adults and $347 for children, with a family cap of $2,085. But as you see on the last line, 2019, the penalties will end. But what that means is no, not this tax year, because this tax year is for 2018 coverage, but rather in 2020, when people are filing their taxes for 2019, they will not see this tax penalty. So this is really important because as people start filing their taxes, I imagine that a lot of folks are going to think that the tax penalty has gone away, that they won't have to worry about this, that if they went uninsured for 2018, that there will be no negative ramifications, but might be very well surprised that there is a tax penalty waiting for them if they do not qualify for the various exemptions that we'll discuss later. So this is a chart that is also on one of Covering Wisconsin's tax-related how-to sheets. I'll be putting the following tax sheets in the follow-up email that will have the survey evaluation linked to it. But these are definitely sheets that I would recommend that you have in your toolbox and that you're using to help answer some of these questions. And so this is when we're talking about tax penalty exemptions, which ones can be claimed on the tax return and which ones actually have to be applied for. And so you'll see that there's actually quite a few that can be just checked off in the tax documentation. And then there are just a few, but maybe a meaningful few, that have to be applied for. And someone won't be able to claim the exemption on their taxes until they receive an exemption certificate. So before we get through the rest of the exemptions, I just wanted to see, were there any questions so far about the tax penalty shared responsibility? Feel free to write it out in the chat box. Okay, well, no questions about shared responsibility, we'll move on. So as I mentioned, the amounts of the tax penalty, it can be up to $395 per person or $347 per child, up to over $2,000 for a full family. However, that is if someone was uninsured for the full year. And the reality that we know is that a lot of people are uninsured for bits and parts of the year. Maybe they are in between jobs and they didn't realize they qualified for a special enrollment period. Maybe they made a little too much money and they lost their BadgerCare. A lot of different various reasons why someone might be without insurance for just a couple of months rather than the full year. And then with those little stints of being uninsured, there's a chance that they might actually qualify for an exemption for those amounts of time that they were without insurance. So a lot of the reasons that people can qualify for exemptions include hardships, life events, financial statuses, and then if they're members of different groups. And we'll talk about each of those different categories. However, one thing that'll be important for you to know is that there is an additional tax form, the 8965 form, where people would be claiming these exemptions. And as I mentioned before, a lot of them can be claimed directly on the form, but there are a few that would need to be applied for. And then you have to wait for that exemption certificate number in order to put it in the 8965 form. So the first type of exemption are the income-related exemptions. And I would say this might be one of the most common types of exemptions that we see. The first one is the affordability test. So this is if someone did not buy insurance because they viewed it as completely unaffordable to them. And so there is a way to test if all of the plans that were available to them, including their employer-sponsored coverage, including the marketplace plans that were available to them, if all of those plans that were available to them cost more than 8.05% of the household income, and this number changes every year. Last year it was 8.15%. This year it's 8.05%. But if the insurance costs more than that amount compared to the household income, then an exemption can be used. This is one of the few exemptions, however, that has to be applied for. So there is actually an application, which I linked in the application required section of this little piece, where you can see what that application looks like and what they would need to fill out. And these forms are the exact thing that us CACs and navigators can help someone fill out. So if you find out that their plans that were available to them were very expensive, you can offer your assistance in helping them apply for the exemption that they can then provide to their tax preparer. So that's probably one of the most common ones. What I would argue is also another common one is a consumer whose income did not meet the tax filing threshold. And so this year, with the tax law that just passed in early 2018, there are some significant changes to the threshold for a single and a couple in having to file their taxes. So for a single individual, the tax filing threshold is $12,000, and for a couple is $24,000. So what this means is that if you find someone who didn't have insurance all year long, however, is making less than $12,000, and they're just a household of one, they won't have to pay the penalty because technically they do not have to file taxes. The one little caveat is that if someone had insurance through the marketplace, whether it was for a couple months or what have you, they are required to file their taxes because they received some type of financial assistance from the marketplace. And when we talk about tax credit reconciliation, that'll come out a little more, but that's very important because we do see some folks that might have transitioning incomes that had marketplace for a few months, but then maybe decided to not apply for BadgerCare when they were eligible, or they just went without insurance when their income went down, that actually still need to file their taxes to reconcile those tax credits, but technically would be exempt from doing so because their annual income is still below the threshold. So just something to keep in mind while we continue this conversation. So then another common, and I say common just because there's so many different types, but another common type of exemption is the hardship exemption, and this is the other type that needs an application. And these hardship exemptions allow someone to take essentially an exemption from a couple of months when they were experiencing the various types of complicated situations. So examples like homelessness, facing eviction, shut-off notices from the utility company, domestic violence, death of a family member, all of these are allowable exemptions, but you have to apply to the marketplace for that certificate, that number that they can include in their exemption form when they file their taxes. And it's important too, because what I recommend when people have some of these situations that they're dealing with is to actually apply for the exemption right away so that they actually can qualify for a special enrollment period as well. Because a lot of these allow for just that. Someone might be dealing with, their power going off and they missed the opportunity to sign up for health insurance when they had a special enrollment period to begin with. And when they are able to send in that exemption form, they would get the exemption for those several months that they didn't have health insurance because they didn't apply. And then it might actually open up a new special enrollment period for them to enroll in coverage. And so what I recommend is that you get pretty familiar with these different categories. And I put a link of all of the various hardship exemptions so that you can actually identify when a consumer comes into your office why they went uninsured, and see if you could actually help them complete the exemption right away so they don't have to wait during tax time to receive that certificate, and you might end up getting them health insurance coverage in the long run. And then there's a few health coverage related exemptions. So someone who has been uninsured for no more than 2 consecutive months of a year, they can essentially be exempt just because they weren't uninsured for a very long time. Just under 2 months, they wouldn't have to pay any type of penalty. And then in our state, this applies. If a person lives in a state that didn't expand Medicaid, then they can qualify for an exemption if their income is below 138% of the federal poverty level, which is what the expansion of Medicaid would have allowed them to qualify for our Medicaid program. And so this is just kind of an added protection to those individuals that should have had the opportunity to qualify for our state's BadgerCare program, for example, but didn't because our state decided not to expand that program. And that means they don't have to pay the tax penalty as long as they're below that threshold. And then these are other common ones, group membership exemptions. So if someone is part of a federally recognized tribe or eligible for Indian Health Services, they do not have to pay the penalty. If someone is a part of a recognized healthcare sharing ministry, so these are kind of the alternative to health insurance plans for folks that qualify for their eligibility. And then members of a recognized religious sect that has religious objections to insurance. So most commonly in Wisconsin, those would be folks that are either Amish or Mennonite. And then just a few other exemptions. There actually are more, so I would recommend going to the link below. But most common ones are folks that have been incarcerated. They do not have to pay the penalty for the time that they were actually in jail or in prison. And then someone who was either living abroad, a U.S. citizen living abroad, or someone who is a non-citizen or undocumented status. So that means they would not have to pay the penalty. And this is actually kind of one that happens to cause a lot of issue because when the law first came out and people were filing their taxes in the first couple of years, I heard a lot of undocumented immigrants being charged the penalty, even though they should not have been. And so several of them did end up having to go back to their tax preparer and get that fixed. And one thing about tax preparation is you actually have up to 3 years to amend your taxes. So if, for example, if someone got charged a tax penalty and shouldn't have, they can go to another tax preparer and get their taxes amended and ideally fixed. For that undocumented immigrant, if they have a child that is a U.S. citizen and that child was uninsured, it is actually valid that the child would be charged a penalty towards the household. So it's important for them to know that if their child went uninsured, that there's a chance that that penalty was actually accurate. And then for anyone who is waiting for their exemption certificate, if they had to apply for an exemption, some folks might get antsy in order to complete their taxes and might not want to wait till the very last minute for their tax certificate. And so they can go back and amend their taxes if that's really the option they want to take, or they can have their taxes pending until they get that certificate and then include it for that time. But this is all that I would recommend that consumer talk to their tax professional to figure out what route is best suited for them and their family. Because if it's the difference of, several hundreds or thousands of dollars, it might be worth it for them to wait to make sure that they get all the return that they're owed. All right, so any other questions about exemptions? I'll just give a minute or so if anyone wants to ask anything regarding the exemptions before we move on. Okay. Well, then I will move on. All right. So this is another little snapshot of one of our Covering Wisconsin tax resources. It's named Don't Lose Your Health Insurance Discount. And this is just a nice sheet that helps a consumer get ready for when they meet with their tax professional and to figure out what they need to bring, what materials they need to be ready with so that they can complete the tax credit reconciliation process. And the reason we named this sheet, Don't Lose Your Health Insurance Discount, is because if someone does not complete the tax credit reconciliation, it can directly affect if they get a tax credit the following year. And we've actually seen that where folks did not do their taxes and they come back to get help in signing up for health insurance and realize that they're not getting the same type of financial assistance, and it's usually directed to them not reconciling their tax credits. But what does that even mean? So someone who has marketplace health insurance, they, in the application, are signing up to get two different types of financial assistance. And of course, that's if they qualify based on their income and their eligibility. But there are two types of financial assistance: the advanced premium tax credits and then cost sharing reduction. For tax purposes, we're going to really focus on the advanced premium tax credits. So this is the discount or the monthly amount that the marketplace gives directly to the health insurance companies to lower the cost for the consumer of their insurance. And so the consumer would then only be required to pay whatever the difference is of their monthly cost. And it's because of these APTCs that they need to complete their taxes, because the way that the tax credits are figured out is based on their income that's estimated. So they estimate their income, and then, I'm sorry, I think I'm skipping. I'm getting ahead of myself. So the APTCs are a type of financial assistance that help people lower their costs, which we've mentioned. And then to qualify for them, they need to show their estimated income for the year. And that's for the year that they're going to receive coverage. So for this last open enrollment period, we were helping people estimate their 2019 income. And then when they file their taxes in 2020, they're going to take the required forms that the marketplace gives them so that they can determine what their actual income is and see if there's any discrepancy on the amount of tax credit they received. And so, as I mentioned, if they do not reconcile these tax credits, they can lose their financial assistance for following years. And the forms that they need are the 8962 form. This is the form that the tax preparer will use to compare the two different types of tax credits that they could have and should have received. And all of the information that they use to fill out that form is from the 1095A form that we talked about before. So the 1095A form proves that the person had marketplace coverage, whether that's for several months or for the full year, but then it also shows how much in tax credits they received each month. And that's what's going to be compared in the 8962 form with what they actually should have received based on their actual income. And so here is just a snapshot of the two different documents, and all the forms I linked into the presentation, so you should be able to access them and see them and explain them to others when they ask questions regarding any of this information. But this is kind of what it looks like. So the 1095A form, I know it's small, but you can kind of see at the very bottom, all the months are listed out. And so right next to it, they would have how much tax credit they received. And then from this sheet, the 8962 form, you can also see that there's months listed out. They have essentially what their premium would be, what the tax credit was, what their tax credit should have been, and then eventually they get to a final number of what is owed. And this is why I emphasize we are not tax experts. We do not fill these forms out for anyone. All we can do is we can help them access those documents. So the 1095A form is what we will be helping people access. And this is on their healthcare.gov account. When you go into their application for the year that we helped them, or the year that they're applying, so for this year it would be 2018, we would help. So in the actual application, there should be a link to tax forms, and then they would be able to print and download their 1095A form. And how reconciliation works is that if the household income is lower than the estimated income for that year, they might actually get more of a tax credit in their tax return. However, if the household income is higher, then they might actually have to pay back some of those tax credits. And I know what you guys are thinking, because we've seen some very high amounts of tax credits. So the idea of having to pay any of that back, like that can easily be thousands of dollars, right? And in some cases that's true, but the reality is there are thresholds for how much someone has to pay back. So if someone is less than 200% of the federal poverty level, then they actually are capped at $300 of what they have to pay back in tax credits if they're filing single. And then for any other status, so any other head of household, married, any other type of status, it's capped at $600. If their income is between 200 and 300% of the federal poverty level, then it's capped at $775 for a single individual and $1,550 for any other status. And then between 300 and 400% of the federal poverty level, the difference, or the capped amount that they would have to pay back, is $1,300 for a single and $2,600 for any other status. However, if someone is making more than 400% of the federal poverty level, which we know is kind of the cap for tax credits, they would have to pay back all the tax credits. And what that means is that the federal government is saying you shouldn't have qualified for tax credits to begin with because their income was beyond the marketplace allowed eligibility limit. And so these ranges I've seen in effect, and this all varies because some people might not have to pay anything because there was no discrepancy. Some people might pay less than even their cap, just because it's whatever the amount is. It's not whatever is more, unlike the penalty. But in most cases, this cap really protects people because, as we know, 1 month of tax credits could be, $1,000 or $2,000 in some cases. And so even having to pay 1 month back, let alone a full year's worth, could be really just a financial burden on a lot of people. So they put these protections in place so that no one would be expected to pay that full amount beyond someone who was not eligible for tax credits to begin with. So then just one other little reminder. We're getting close to the end of the presentation, but what are some other ways to help during the tax season? I know that I've mentioned helping people pull the 1095A forms from their account so that they have access to that document. If they don't have a healthcare.gov account, you can help create one and then link their application ID that they did over the phone with their new healthcare.gov account. That usually allows you to pull that 1095A form. And those should be available starting soon. Usually it's by the first couple weeks in February that 1095A form is available. You can also help people now and throughout the year in completing hardship exemptions or the financial affordability test exemption. or helping them understand what exemptions they might be able to claim for this last year. So in 2019, we no longer will have to worry about exemptions, but that's something that, at least for this last year, we can help them complete. And then finally, of course, whether it's because you helped them get a successful exemption or just in general, making sure that you're familiar with the different special enrollment periods that are available to folks. So these are the ways that people can qualify for the health insurance marketplace if they had a loss in coverage, if they're moving, specifically moving out of an area that their network was covering. They do have to have health insurance to qualify for the moving special enrollment period. Changes in household size, immigration status. This one I've actually seen quite a bit of. For example, if someone becomes newly eligible for their work permit, or if they became a new permanent resident, or if they became a new citizen, all of these would allow for a special enrollment period, and you do not have to have had insurance prior to this immigration change. So that's one that I've been able to help folks enroll in. And then, of course, if someone is released from incarceration or jail. And then, of course, emphasizing that BadgerCare Plus, someone can apply at any time. And then just so you know, I do have a survey that I would like for you guys to complete. And so that'll be sent to you in a few moments, but otherwise, the presentation that I sent this morning, you can also click on the link to complete the survey. And then I'll open it up to questions. Should I unmute it? Let's see.